Imagine two investors analyzing the financial market at the same time. One is studying company balance sheets, reading economic reports, and trying to understand long-term trends. The other isn't looking at charts or news or fundamentals. He simply let an algorithm trade automatically. The curious detail is that today, a huge portion of trading in the financial market happens exactly like that, executed by automated systems making decisions in fractions of a second. That raises an interesting question. Is the financial market still driven by human investors, or has it largely become a game between algorithms? My name is Chad. I'm the host at Zero Markets, and in every video, I bring the perspective of our specialists to help you become more critical about the market. For much of history, markets were dominated by human decision. Investors analyzed companies, they assessed risks, and they made decisions based on interpretation, experience, and expectations about the future. But over the past few decades, technology has deeply transformed this dynamic. The growth of high-speed computing, data analysis, and quantitative models opened the door for automated strategies that now execute millions of trades every day. Today, a significant portion of trading in the financial market involves algorithms operating based on mathematical rules and real-time data analysis. And this leads many investors to ask whether market behavior still reflects human decisions, or whether we're increasingly dealing with a system dominated by machines. In recent years, the growth of so-called algorithmic trading has significantly transformed the structure of the financial market. Large financial institutions, hedge funds, and technology firms have invested billions in systems capable of analyzing massive amounts of data and executing trades at speeds impossible for any human. These algorithms can identify statistical patterns, they can respond to price changes in milliseconds, and they execute complex strategies automatically. In many markets, especially in the US, it is estimated that more than half of the daily trading volume is generated by automated systems. Now, this doesn't mean humans have disappeared from the process, but it shows that the infrastructure of the financial market has become far more technological than it was a few decades ago. There's a common perception that algorithms control the market, but the reality is a bit more complex than that, because most of these systems are not trying to predict the future or the economy or decide which companies will succeed in the long run. In practice, many algorithms are programmed to perform specific functions within the financial market, such as providing liquidity, exploiting small price differences between assets, or reacting quickly to temporary shifts in supply and demand. Now, these strategies make markets faster and, in many cases, more efficient. At the same time, they can also contribute to sharp short-term movements, since thousands of systems may react simultaneously to the same market signal. Despite the massive presence of technology, there is a fundamental aspect of the financial market that remains deeply human: long-term strategic decisions. Now, algorithms execute trades, but investors, asset managers, and institutions define the strategies behind these systems. They decide which models to use, which risks to take, and which economic trends may matter in the years ahead. Moreover, major structural movements in the market, such as economic cycles, technological shifts, or changes in monetary policy, continue to be influenced primarily by human factors. In other words, algorithms accelerate the functioning of the market, but the overall logic of the financial system is still deeply connected to human decisions and expectations. The growing presence of algorithms shows how the financial market has evolved over the past few decades. Technology has transformed the speed, the efficiency, and the complexity of trading, creating an environment very different from the era when transactions were executed manually on physical trading floors. But despite this technological transformation, the market ultimately remains a system built on human expectations about the future. Algorithms can execute strategies, they can react quickly to prices, and they can amplify certain short-term movements. But the major narratives shaping the financial market still originate from decisions and interpretations made by investors. Understanding this combination of technology and human behavior may be one of the most important skills for anyone trying to interpret markets today. If you want to understand how the financial market really works, from short-term movements to the major structural changes in the global economy, follow Zero Market. Our goal is to analyze markets with depth, context, and strategic thinking. We'll see you in the next video.